give you kind of a reference point. In 1982, a mortgage, today a mortgage is give or take 5% if you're looking for a 30-year fixed. Today, in 1982, that number, 16.6%. Let me let that live for you for a second. And today, mortgages are 5% with an inflationary number of 9%. In 1982, we had the same inflationary number of 9%, and mortgages were not 5%. They were 16.6%. Also, car loans, 11%. Credit cards, 17.3%. These are multiples of what our current interest rate environment is. So the question then begs, is inflation too high? Has the number run up too fast and the market is betting that it's going to come down? And because its interest rates haven't risen as fast as inflation has? Or are rates too low and we are going to see a quick rise in interest rates to meet the real inflationary numbers that we're seeing out there? Just to give you an idea, there's an old saying in our industry, and that old saying is pretty simple, which is don't fight the Fed. The Fed is, and for those of you who don't know, the Federal Reserve is the central bank for the United States government. It is very similar to other central banks around the world, ECB, the European Central Bank, the Bank of England, the Bank of Japan. Those are the big ones. And their job largely is to manage the money supply. And by managing the money supply, they have to have a target. And usually the first target that they have is inflation. So, and inflation, when I mean inflation, as far as the Fed goes, they describe inflation as their goal being price stability. So the Fed, our Fed actually has our central bank has two objectives. They have price stability, number one, and then full employment is their second objective. So they want to keep prices stable because as we look at, if you're a business owner and you're looking at the cost of doing business, borrowing money is a huge portion of your business. And borrowing money and the cost of that borrow is what is going to affect your willing to spend. So if interest rates are very low, often you see businesses willing to borrow more. Interest rates are high, they borrow less. And if borrowing goes down, that means employment, their ability to hire goes down, their ability to invest in their business goes down. And ultimately, often you do see, at least eventually, a slowdown in earnings because of that slowing investment in business. And so from our perspective as an investor, how do we take this information and move forward confidently? Well, let's put it into context. In 2008, the last time the Fed had what was the first big expansion on the money supply, from 2008 to 2015, the Federal Reserve printed $5 trillion new dollars. Now, when I say printed, the Fed really has two specific tools they can come and keep those two objectives in place. One, price stability. Two, full employment. They can either adjust interest rates. They have the ability to affect mostly short-term interest rates, but interest rates. Or two, monetary policy. And monetary policy basically says, if short-term interest rates are already at zero and you can't make interest rates cheaper than zero, if you're the Fed, technically you can. But let's say we're going to go to zero and that's our bottom number. The additional tool that we have is to basically just go outright and print new money.